Okay, on our next video, the Federal Reserve, we're going to go through the tools that the Fed uses to change the money supply. Now, there's easy ways to change the money supply. Remember, you can just throw it out on the street from a helicopter and that'll increase the money supply. Or a dictator could just have the central bank print up the money and give it to him or her and spend it on palaces or put it in a Swiss bank account. But that's not normally the way it's done in this country. Then we'll go through the Fed's balance sheet because the Fed has to keep track of what they do with that money, how much they've printed, and what do they do with it. Okay, so first, the tools to change the money supply. The most common way to do it in this country is with the open market operations. This is the buying and selling of US government securities, bonds. So this is open market operations. And this is the open market purchases and open market sales. So open market purchases and open market sales, where they're going out on the open market and buying and selling. And what they're buying and selling is the government securities, which is another way of saying the government bonds, the T-notes and the T-bills. That's what they would prefer to buy. They're also able to go buy things from government-sponsored enterprises like Fannie Mae and Freddie Mac when they need to. So during this last financial crisis, they actually did buy a lot of mortgages from Fannie Mae and Freddie Mac because that market was starting to freeze up. Housing prices were falling. People didn't want to buy mortgages on homes because there was a big risk to it from housing prices falling. And the banks really didn't want to make the loans either. Normally what the banks do, they make a loan for a house and then they hold on to that loan really for just a short period of time. And then they sell that loan to somebody else because they want to get more money so they can make another loan to somebody else. That's how they really make their money. They're very good at making loans and servicing the loans, but they don't have an unlimited amount of money to use for making loans. So they make the loans, they sell them to other investors, or they sell them to Fannie Mae and Freddie Mac, which are these government-sponsored enterprises that just buy up mortgages to make money available for people that want to buy homes. Then the Fannie Mae and Freddie Mac, they'll take all these mortgages, lump them up together, and sell them off to investors. During the last financial crisis, people didn't want to buy these mortgages on homes. They got burned on them. They lost a lot of money. They weren't buying them. So actually the Federal Reserve stepped in and made money available, and they started buying up the mortgages for people so that it would make more money available in the housing market. People could get loans or refinance their homes. If you bought a home or refinanced a home around that time, 2012, 11, 13, chances are the money came directly from the Federal Reserve to purchase a house or refinance a house. They're also, as I said, able to go beyond that sometimes. In their charter, if there's unusual or exigent circumstances, they can actually do more and go buy additional things than that. Although they prefer not to, only in case of emergencies. They do have that power to go out and buy other things if they want to. The second way to change the money supply, which isn't used nearly as much, is by lending to banks. And this is the whole reason why the Federal Reserve was created, so they could lend money to banks in bad times, in panics, or when there's bank runs. This is rarely used. This is just to satisfy their role as lender of last resort. I'd always heard the term lender of last resort, but hadn't actually seen it until 2007. I'll show you what happened in August of 2007. They had $250 million out in loans to banks. Not very much at all, just a little drop in the bucket, because the monetary base was around $1 trillion, a little bit under that. $250 million, not much. And those are just temporary loans to banks that need the money and it's going to be paid back. By November 2008, when things got bad in the economy, the financial crisis was going on, they had loaned out $735 billion in loans to banks. So about $750 billion that they had loaned out just to help the banks have enough money. They're only supposed to loan money to banks and not loan them to non-banks. So at that time, there was a problem because all the investment bankers were going broke or about to go broke. They let some of them go. And their reasoning was they couldn't really help them because they weren't banks. They got around that problem by turning all these investment bankers into actual banks. Once they were banks, officially banks, then they could loan money to them, like Goldman Sachs. Well, Goldman Sachs, they made it into a bank. Then they could bail them out, loan them money. The third way to change the money supply is by changing the reserve requirements. The legal requirements the banks have to hold of their checking accounts. This is not changed very often, rarely used. Maybe once every 20 or 30 years will they change this. Some governments use this quite a bit to change the money supply. China uses it quite a bit. They change these reserve requirements regularly, and that affects the money multiplier. The latest tool the Fed has to change the money supply since 2009 is interest on reserves. This is the interest rate that the Fed pays banks on their reserves that they deposit with the Fed. And the purpose of that is so that they can adjust this interest rate up and down, and that will affect the amount of excess reserves that banks keep. And by changing the excess reserves, it'll change the total reserves, which changes the money multiplier. So if they want banks to loan out a lot and get the money supply increased, they can bring that interest on reserves down to zero, and then there's no incentive for banks to keep any excess reserves. If they want the banks to keep more excess reserves, decreasing the money supply as measured by M1 or M2, then they could pay a higher interest rate on those reserves to the banks and give them some incentive to actually keep excess reserves. So how do these actions that the Fed does how do these actions affect the money supply as measured by M0, M1, or M2? Well, let's first take the open market purchases, open market operations. So we'll have the open market purchases. Does that affect the monetary base, M0? Yes, because when they go out and start buying things, they're printing up money to buy those things, so it increases the monetary base. Will it have an effect on M1? Yes, it will. It will increase M1. because the banks will start loaning that money out. There'll be some money multiplier to it. What about M2? Will that change M2? Yes. It will increase M2 because as M1 goes up, M2 goes up. What about open market sales? Now, open market sales are selling things that they have out on the open market, like their bonds. So they sell all these bonds for money, and they bring that money back to the Fed. It's the opposite of open market purchases. Will it have an effect on M0, the monetary base? Yes. It'll decrease it. Will it have an effect on M1? Yes. It'll decrease it. M2? Yep, it'll decrease it. As M1 goes down, M2 will go down also. What about lending to banks? Will that increase the monetary base? Sure, because where do they get the money to loan to banks? They print it up, they create it, so it increases the monetary base. And then when the banks pay it back, it decreases the monetary base. Will that have an effect on M1? Yes, of course it will. If M0 goes up, then M1 is going to go up too. And if banks pay it back, then M1 is going to decrease. And of course, if M1 goes up, then M2 will go up too. When they pay it back, M2 should go down. What about interest on reserves? They're paying banks interest on the reserves. Will it increase the monetary base? Maybe. I mean, it depends how they get that money. If they print up the money to pay interest on reserves, then yes, it would. If they're using interest that they get on their bonds that they have outstanding and they just use that, then it might not. So it kind of depends on how they're doing it there for the monetary base. But would it affect M1 and M2? Think about the interest on reserves. If they increase it, it gives the banks incentive to keep more excess reserves. They keep more excess reserves, the money multiplier goes down, and then M1, M2 will drop. But if they were to drop the interest on reserves down to 0, then there's no incentive for them to keep any excess reserves, and then the multiplier would increase. So it definitely has an effect on M1 or M2. In fact, that's one of the main reasons for paying interest on reserves. So the Fed has a little more control over M1 and M2. Now we can think of the Federal Reserve as the banker's bank. This is who the banks go to borrow money when they need it. They're the ones that act as lender of last resort. They've got a bank run or something and they need money to stay afloat. The Fed will loan it to them. Just like you have an account with a Bank of America or somewhere, Bank of America has an account with the Federal Reserve Bank. And that's where they keep their reserves. So the Federal Reserve has these accounts for the banks, and the banks keep most of their reserves, required reserves and excess reserves, on deposit at the Fed. Now the Federal Reserve has to have a balance sheet too, just like the banks do. And this balance sheet, also known as a T account, has to balance. The assets have to be equal to the liabilities. And the liabilities of the Fed are their Federal Reserve notes. The IOUs that the Fed prints up and spends. Those are liabilities. And then they spend the money on things, and those are assets. So we can put those in the assets column. So if they go out and they buy bonds, they print up $1 million worth of money, and they go out and buy $1 million worth of bonds from the US government. The bonds are the asset, the liabilities, the Federal Reserve notes are the liabilities. And by buying bonds from the federal government is essentially loaning money if you're buying bonds. Federal government is lending money, borrowing money. The Fed is lending money. If they go out and they buy mortgages, well, then those are going to be over here under their assets. So anything they go out and buy with their money is going to be an asset. During the financial crisis, they went out and bought a bunch of assets from an insurance company because they were afraid the insurance company was going to go broke, and all the insurance companies would go broke after that. Well, those are listed as assets. If they make loans to banks, well, they print up the money, give them the Federal Reserve notes, and then they've got a bunch of loans over here to banks that are assets. Now, you deposit your money in a bank. It's an asset to you. It's a liability to the bank. But then the bank has that money. The checking account is a liability, but the bank has that money as an asset. They go over and they deposit that at the Fed. So these reserves at the Fed of the member banks, which are an asset to the banks, are a liability for the Fed. Now, the two sides are supposed to balance, as I said. You can go out on the internet, you can look at the Federal Reserve, you can take a look at their current balance sheet to see how much money they've created. And what are their assets? What are they holding? Now, before I told you that you could think of the Federal Reserve as just printing money to create money. But it's actually kind of expensive to print money. And if you think about it, I mean, to print a $100 bill is not cheap. And a lot of that money they're going to print out. It's going to, if they were to print it out, they're going to spend it. It's going to go out in circulation. It's going to go back in the banking system. And then the banks are going to keep a lot of it as reserves. And then they're going to take it back over to the Fed, deposit it at the Federal Reserve as their reserves. So these dollars they make are just going to make a big swing and come right back to the Fed. There's a cheaper way to do it that's a lot faster. The end result is exactly the same. It creates money, but it's just a little bit different. What the Fed will do is they'll buy bonds from their member banks. Most banks have a lot of their assets in bonds. They'll buy those bonds. It'll be an asset to the Fed, and then they'll pay for it by just adding something, the amount of money to the accounts that the banks have with the Fed. So they'll increase their liabilities, increase their assets. Think of it this way. You have this car you want to sell. You put an ad on Craigslist. Say it's $5,000 to sell this car. Bank of America calls you, they see your ad, they look at the car and they say, want to buy it, we'll pay you the $5,000. You say, great. You say, do you have an account at Bank of America? You say, yeah, I do have an account there. They say, okay, rather than just give you $5,000 cash for this car, we're just going to increase your account at Bank of America by $5,000. You say, great, I got my 5,000. I was going to take that cash and put it in the bank anyway. That's exactly what the Federal Reserve does. Rather than actually print up this money, go out in the open market and buy these bonds, they just buy these bonds directly from their member banks, have it sent to them electronically, and then just with really just a click of a mouse, just add some money to the account that the Fed has, or that the bank has at the Fed. So increase in the money supply can be done very, very quickly with really just a few clicks of the mouse, and doesn't involve actually having to go out and print more money. They can do that. It has the exact same thing, same effect on the monetary base, either printing the money or increasing the accounts, the reserve accounts here, the accounts that the banks have with the Fed for their reserves, amounts to exactly the same thing. It's just it's a lot faster when they do it that way. Okay, so what we did for this video is we went through all the tools to change the money supply. And the most important one there is the open market operations, buying and selling of bonds, the open market purchases, where they're going out and buying bonds, spending money on those bonds. That puts that money out in circulation and increases the monetary base. The opposite is taking those bonds and assets that they have, going out and selling them, and bringing that money back to the Fed, where they can just stick it in the room until they need it or burn it, but it decreases the monetary base. Then we went through the bank's balance sheet, their assets and liabilities that always have to balance out. And that way we can see exactly what the Fed is doing. We can see exactly how much money they've created. We can see what they're holding on their balance sheet, what they've spent that money on, all those trillions of dollars that have been spent. Where is it? What do they have to show for it? It's on their balance sheet. And then we can also look and see how much the banks have on reserves. So that we can calculate any kind of number that we want to with M1, M0, or the money multiplier.